G'day everybody and welcome to this week's podcast with Jerome Fogel. I'm on like a little sort of, mission here to help founders who are going to be selling their businesses get as much information as possible to make sure they get the best outcome possible for them. You work so hard. You're a founder listening to this, you're thinking, man, I work really hard. You're probably only going to do an exit once. So I want to make sure I give you as much information as possible from experts and from myself to help you really get the best outcome you can for your business. So today is the third episode in just a few months. I did a couple with Sean Flynn, which will have just been released in the last month or so. So go back and have a listen to those if you haven't listened to those. He's an investment banker, does a lot of work in this space as a sell-side advisor. Jerome Fogel also does a whole bunch of advice in this area, and we covered entirely different things than I covered with Sean. So today we looked at what are the characteristics of a business that might get 3 times earnings or 5 times earnings or 15 times earnings? Like, what are the characteristics of the business that's actually going to be more valuable? I think that's really insightful. Negotiating tips, things that you should think about in the preparation of your business leading up to a sale. So you may not want to sell for a couple of years, but what should you do in the next 12 months? Things that you can really easily do wrong in the due diligence process, or things that actually you can do super well in the due diligence process that make the deal even more attractive for a buyer, and common mistakes made by sellers. It's an action-packed, value-packed episode. I think you're really going to enjoy it. So if you're thinking about selling in your business, this is one you want to listen to. Enjoy.
Welcome to the Scale Ups podcast, where each week you get to hear Sean Steele, professional CEO, growth mentor, and advisory board chair, unpack the strategies that successful founders have used to achieve scale in their businesses. Stay tuned as he interviews the entrepreneurs who've made it, learns from industry experts, and follows a group of founders still striving to scale.
G'day everyone and welcome to the Scale Ups podcast, where we help first-time founders learn the secrets of scaling so they can fulfill the potential of their businesses, make bigger decisions with greater confidence, and maximize the value and impact they can create in the world. I am your host, Sean Steele, and my guest today is Jerome Fogel. How are you today, Jerome?
Doing great. Yourself, Sean?
Mate, I'm absolutely super and excited about our conversation today. We've had a couple of conversations offline, and for those who don't know your background, maybe I'll give a few quick insights, and you can correct me if I'm missing anything key. You're fundamentally you're a deal maker, right? You're a deal maker, but you're also an innovator in the legal space, and you've participated in north of 100 transactions, be they in corporate or sports or entertainment. You've been on both the buy and the sell side, capital raisings, a million different kinds of contracts and agreements and structures. And you're also an offsite general counsel for some small to lower to mid-size, mid-market kind of businesses, and selected in the last couple of years, if I'm not wrong, as a rising star in the super lawyers, which I think is really cool, and also part of the EO Accelerator program. EO, for those regular listeners, you will have heard us talk about EO before, the Entrepreneurs Organization. But that means you probably get to see a lot of businesses trying to scale and get some really interesting optics on some of the earlier stage ones. Mate, that sounds exhausting. Did I miss anything really key that you think I should have explained to people?
That's it. I see myself as a deal maker with a 360-degree view of deals. So whether it's representing an early stage company that is raising money for the first time, or they're more sophisticated and have a $500 million valuation, or venture funds that are being put together, we help them fund or form their fund. And then on the third side, we work with athletes doing off-field transactions, and we're very deal focused, M&A, capital raises, venture funds. So that's really the common theme.
Well, this is one podcast, mate. There's not too many that I can get my kids to listen to, but this is one podcast I'll definitely be getting my elder one, who's he loves business, he loves legal, he loves kind of economics and stats, and I'm trying to go, hey, like, there's really interesting stuff that you get to do. There's a lot of creativity that happens in deals, mate. Like, there's so many interlinking pieces. You have to have such wide knowledge, and then be able to really create an amazing outcome. So I think this will be fun, mate. I'm excited. And I guess the point of our conversation today is, I have I've recently done a couple of episodes with Sean Flynn. I'm really trying to unpack the secrets of, for business, most founders who are in that kind of 2 to 20 mil range, if they sell at some point, and many are interested in some kind of an exit where they've got a transaction, bag of cash and walk away kind of model. And I'm almost doing a bit of a mini series here because I've got one client who's just exited. I've got another one that's just embarking on the process. I've got others that'll be in the process in the next 3 to 5 years, and some may never sell and have more of a lifestyle business, and that's really not their objective. But what I want to do is get them thinking about, if I'm only going to do this once, then how do I really need to put some effort into it, right? Like, how do I think about preparing to get the best outcome for me, given I'm probably only going to do it once? Kind of like my wife always said to me, it's like a major piece of renovation in your house. She's like, you're probably only going to do it once, so like, you put the effort into YouTube, but you're not going to do this over and over and have time to perfect it. You just got to accept that you're probably only going to get one crack, so just put the work in.
That's right. That's right.
So lots of ground to cover today. I'd love to talk about things like some of the common mistakes, things I think, really interested in things that you found in due diligence that scuttle deals. Because when you're on the selling side, sometimes you don't really know why a deal's gone cold. And actually it's because of stuff that, they might have discovered during due diligence that you weren't really thinking about. And all of a sudden it just made them a bit nervous. Things that you think business owners might want to do in preparation if they've got, say, 12 or 24 months before they know they want to transact. Things that they should they be doubling down and investing heavily to accelerate revenue growth, or plant some new seeds of new revenue streams to get the buyer excited, or should they be really doubling down on profitability, reducing costs, just sort of tightening things up? It's interesting set of optics. And one of the things that always comes up for a seller is, well, how do I, if I go out to market and someone says, oh, your business is probably worth 3 or 4 times, what do I have to do differently if I want to get 6 or 7? And what are the characteristics of a business that gets, 10 to 15? Like what's the difference that makes the difference in those kinds of businesses? So plenty of ground to cover. And let's just jump straight in if we can. The common mistakes made by sellers. What is the stuff that you see? Sometimes I'm sure you end up rolling your eyes. Sometimes you
Hmm.
laugh. You probably see it over and
Hmm.
over. What are some of the things you see?
Yeah, and it's great. This is great. First off, great coverage that we're going to do today. So I'm really excited. I think, interestingly, I was having lunch with an investment banker today, and we were just talking about what are the types of common issues that we see. And I think that the big theme is that, for the most part, it's the seller's, like you said, first and only time. So they don't have experience and they don't know what they don't know.
Mm,
And so I think, but to be an entrepreneur, you've had to be very successful. You've had to bootstrap. You've had to be very scrappy, and so you've been used to tackling new things. But when you're doing a sale, this is something that is unique. There's sophisticated players in this space. So you're dealing with a very different animal than your typical deal that you're seeing when
mm,
you were running your business. You weren't dealing with these types of sophisticated players and numbers. So I think that the stakes change. That's the first off, the background is the stakes have changed. There's different players. And so I think that so then what happens is, if you don't realize that, what you do as an entrepreneur is you may just step into the deal like a bull in a china shop and think that you can
Figure
make
it
the
out as you
deal
go.
happen.
Yeah.
Yeah, so that's number one, is no planning, just step into the
Mm,
deal.
hmm.
Hey, this looks great, and you run into a lot of issues. I think that's the first thing. The second thing is not getting advisors in your corner. Now, ideally, I'd love every entrepreneur to start early with the investment banker, with the wealth manager, with the attorney. It doesn't always happen. We get deals sometimes 11th hour LOI stage. I've come in the middle of deals, but typically we like to work with a client. Like, I was working with a client, 4 to 5 years prior to their sale. So we're able to really get a lot of things together, get the corporate side together. We're able
Mm,
to get their IP side together, right? So it's really important to be able to do that early. So I think that the third mistake is they don't start doing these things early.
hmm.
An institutional buyer, especially, is going to look at corporate governance from inception to present. They're going to look at third party consents, things that you wouldn't think of as an entrepreneur, that you didn't have to run your business doing. But now these are going to be front and center for a typically sophisticated buyer if you're in the,
Mm.
20 to plus million, even some of the 10 plus million deals as well. So
That's, I
I
think about
yeah, I
yesterday.
think
I
yeah.
had a client yesterday. We were talking about a deal that they're just sort of embarking on, and he said, do you think now's the time to get the right lawyer? And I was like, absolutely. And if you think about it, even when you haven't considered the fact that in due diligence, everyone's going to see the contracts that you've got. And so, what can we do to strengthen those contracts and, tie down the right things? And what about your IP? And so now's the time to be having those conversations. Absolutely. So we've already got tax planning, tax and wealth planning happening. We're making introductions to sell-side advisors. We're looking at the who's going to be the right solicitor to help them on the journey. Because to your point, you've got to get that team organized
That's
and get
right.
the risk profile aligned, right?
That's right. That's right. I mean, I think that, there's 70, I think we have 70 factors that we look at because over the time of doing deals, whether we've been on the venture side or the sell side or the buy side, here's the common things that you need to address as a seller from a corporate governance perspective, from IP, from employment, from privacy, your cap table, all these things come into play. And then to your point too, it's the risk profile. So, I look at, some entrepreneurs are more cowboys. Some are going to be more detail oriented and want to read the contract and get into all the details. I've had entrepreneurs, highlighting different colors, different parts of the and some don't read it. So it's just a very wild range. To simplify it, I just tell entrepreneurs, hey, listen, think about this deal. Is this going to be, a green light deal, meaning go no matter what? Is this a yellow deal where, hey, there's caution, or red where you're really not sure? But I have to educate the entrepreneur of what I'm looking at the deal. For
Mm,
example, and this, I mean, when you present a deal, the highest bidder may not be the one that's going to close. And I have to explain them, hey, if this is a newer entrant into the market, they're probably going to be afraid when they look under the hood versus somebody who understands the market. And
yeah.
maybe they bid a little bit less, but they're more likely to close. So I have to, you know, educate the client a little
Mm.
more to make an informed decision on those colors.
Mm, yeah, so true. Or they may be more flexible. One of the buyers, because of their likely profile of risk, as you just said, one might be quite happy for you to leave much earlier, and the other one's like, no way. Like they don't understand your business model, so they're not going to let you go anywhere in a hurry. And if you want to be out quickly, then which not every entrepreneur does, but if that's a
Right.
thing, then you better be speaking to somebody who actually understands your business model, has existing resources, can deploy people straight away if anything goes wrong, like that their risk profile is lower. So yeah, they may not give you the same premium, but they're probably going to be much easier to transact with and get you maybe some of the other things that you're looking for in the deal, some of the other terms you want.
Exactly. I think it's really important to know as an entrepreneur. I've won one deal that I did recently. An entrepreneur had to stay on. I think it was 3 to 6 months, and he
Hmm.
told me it felt like you know his wife got remarried and he was living in the basement because as the deal had been sold, the company was no longer his, but he was still there, and the employees weren't his, and he just kind of felt weird about it. But I think
Yeah.
that's some entrepreneurs, they're just by nature dreamers and visionaries,
Mm.
and it's going to be hard for them to, but I think staying for a few months does have some value. I know some want to wash their hands,
Mm.
but I think there is institutional knowledge, especially
Mm.
where you've had your hands in a lot of parts of the company. It's important
Yeah.
for the entrepreneur to stay on for a few months to help the deal. Especially if you have an earnout, it's going to be to your
Yeah.
benefit to help out.
Totally. I mean, I've had deals that we wouldn't have considered letting the owner leave within 12 months because of the level of complexity, level of regulation. Regulators would have been looking at who's the key person and who's the character of that person, and if there's a rapid change, they'll get really nervous. And on the flip side, I've done deals where we've had heaps of existing capability. We totally understand the nature of that business. We know what to do if anything goes wrong. And actually, we want those owners out as fast as possible because we know it's going to be painful having to do. We want them out of the way so we can get in and start working, installing our own management, etc. And so you kind of, yeah, it's a really interesting case. What about the due diligence period? I'm really interested in your perspective on this, especially given the legal bent that you bring to this conversation. I quite often, we talked about with Sean how important it is to make sure that everything in the confidential information memorandum matches up with what's in the data room, right? Like you obviously don't want disconnects in that kind of information. But what are some
Mm-hmm.
examples of other things that you've found or you've come across in due diligence that the owner may not have even thought about that was in there, where maybe it was something that was said, in a management meeting, maybe it was something that you discovered, that they hadn't really seen as a risk to them or scuttling the deal, but you were like, whoa, hang on a second, maybe this is not a good one for us to pursue.
I would say the number one of the number one issues is the corporate governance issues, especially not having all the proper board consents, written consents, even the stock certificates, the shares, because a buyer wants to know that there's no other interest outstanding. There's no other options given. There's no other promises, piece of the company. And if you can't show that, it doesn't really inspire confidence in the buyer,
Mm,
especially if it's institutional buyer, Sean, because
yeah.
institutional buyer, there's a lot of an analytics and analysis that's rolling up top. And so if you can't show your house is in order, they're worried that this deal is going to be a circus to complete. And so I think number one off the bat is showing you have your corporate governance in order would
Hmm.
be a telltale sign for buyers to show you have your things together. So
Hmm.
that would probably be number one for me. I think third party consent is probably the number two issue. For example, let's say um, seller had a you know $10 million revolving line of credit or some kind of inventory loan. Let's say that loan was needs to be paid off or will be paid off. You actually will need an official payoff letter from the bank to close the deal, and an institutional buyer is not going to budge on that. And
Mm,
but the bank's motivation, you're talking about people, unless you have the private banking side, for the most part, the wheels grind very slowly in the
mm,
bank. So
hmm.
that's going to hold up an issue. Third
And
party
you're saying,
consents, yeah.
for example, they've got a loan. That loan is actually going to be paid out as part of the transaction,
Hmm.
and so that's fundamentally why you want to make sure that that financier is given pre-approval. That actually that's okay, and it's fully understood, and yeah, okay.
And here's the payoff amount, right? Or
Hmm.
you have a real estate deal, and so you have a warehouse and you've got inventory. Well, you're leasing is the is the landlord going to okay the transfer? You have
Mm,
key contracts. Are did you have provisions in there that allowed you to transfer in the event of an M&A deal, or not say it would be unreasonably withheld? And the buyer wants to make sure all these ducks are going to be in a row, all the schedules are going to be in a row. So I think sellers for the first time, they have no idea what they're getting into, and sometimes some of these agreements they don't even have records of them.
mm.
So they don't keep good records of the agreements. There's issues there. So I think that third party consents and sophisticated buyers will point out right away, hey, here you have to ask them, okay, which are the most important things right now? And third party consents will be one of the first things they tell you.
Yeah.
And I think those can really slow down deals if you don't take care of them.
That was a real challenge actually in education M&A when you were playing in a regulated sector because you couldn't fundamentally the regulator would look at the key people in the new topco, whatever the parent company was, they'd actually look at the directors of the parent company and decide whether they thought they were fit and proper people to have, ownership even of a subsidiary
Hmm.
that's in a regulated space. And so, but you can't go to the regulator before the deal and say, hey, can we have pre-approval? Can you look at our people?
That's
They're like, no,
right.
no, we look at that after you've done the deal. You're like, what? So then, yeah, all of the kind of get out of jail free cards become pretty important. That was a pretty material third party consent that I saw a few businesses really get wrong, where the
Huge,
regulator
huge.
wouldn't approve it, and it's like, okay, what do we do now?
And you've got in the US a very active administration on the antitrust side.
Hmm.
So those you need to get those things rolling well in advance, especially on the bigger deals.
Okay.
And you get specialists involved there too.
And so on the flip side of that, then what are the things, and some of them may be the opposite of what you just said, and some of them may not be, things that you've found in due diligence that have actually materially increased your confidence in the deal because it makes them
Hmm.
seem, I don't know, more professional. They've even more so got their ducks in a row, or it's like another level up to what you would see in the general kind of population that you thought, actually, that really strengthens our conviction in the quality of this business.
Right, right. No, that's a really good point. I look at when doing an acquisition, I look at the responsiveness of the seller and their advisors.
Mm,
So when we send out a diligence request, I look at how completely and thoughtfully they're filling these out. Some sellers will just say, "Hey, I don't have this information," or you send a 10-page diligence request, you get maybe 5 answers, and I just tell the client, "Listen, this is not a really thoughtful response to these questions, and I don't know how much in order this business is if they can't give you thoughtful." So I look at how thoughtful, how responsive are they to diligence. That's probably number one on my
mm,
list. um I would say number two would be numbers. There's a story, this is a true story, of an acquisition that supposedly was being done of an Indian company, and this doctor essentially, had these recipes or formulas that he would sell to manufacturers, and it was showing incredibly profit. I think it was like 60% gross margin or something like that. And so the buyer wants to verify this, so brought in a forensic accountant, and the accountant tried to verify all of the receipts. And then the doctor kind of met with the doctor, and the doctor said, "Oh, all this is valid. You can, you know, but then the forensic accountant said, "Okay, well, why do you want to sell?" He said, "Well, I want to, I have a mango farm. I want to retire to and just enjoy." At any rate, when they finally sent they all the invoices that were paid, they sent those invoices to the clients to get verified, and then the faxes came back from an unknown number, and the forensic accountant suspected something was amiss. It turned out that the doctor had fabricated all the numbers, and there was no real business. They hadn't done business with those clients in 5 years. So the second
jeez.
thing is the numbers.
Mm,
Are they being honest and truthful in the numbers? And I think that is a big one for
mm,
buyers. Now, there's always some creativity going on in
mm,
terms of in terms of an analysis of the numbers, and each side should be getting an analysis of the cash flow numbers. But I think that's a big one, Sean, is
yeah,
how honest and integral are they in their numbers?
yeah.
And I think that's a huge red flag. I presented you a scenario that was really an outlier, but
Mm.
honesty and integrity in numbers, that's a big one.
I've seen that. And you think about, when I was growing up through the ranks, I kind of come through the sales side before I sort of
Mhm.
became a CEO. So I wasn't really that involved in corporate finance, and I didn't have that grounding. And it was only later on that I realized in some of my first executive roles how much subjectivity there is in accounting. I just assumed it was like this kind of black and
Mhm.
white profession where everything's just rules, and it's like, yeah, there's rules, but there's so much interpretation, and there's so much in things like, okay, how are we going to recognize revenue? For example, are our expenses matched to our revenue really in an appropriate way? And of course, you can imagine being a seller who wants to, prep their business for sale, all of a sudden changes their accounting policies, starts bringing a whole bunch of revenue forward on some hypothesis that they came up with a dodgy accountant, and has kind of kept the expenses the same, or even maybe further delayed the expenses, that driving it from two directions to make the business look more profitable. But I think I always have to advise to owners is just don't get cute. Like to your
That's right.
it wraps back to your earlier point. The quality of the people that you're going to be dealing with, if you're doing a professional M&A transaction, they are not going to miss a thing. They see this.
That's
That's
right.
exactly what they're looking
That's
for.
right.
So you're not
Quality
getting
of
away with
earnings.
anything. Yeah,
Yeah, yeah, yeah.
quality of
You
earnings,
said it
100.
right. They're not going to miss it. That's right.
No, they'll be asking because they have to understand your financials well enough to build their own model for the next several years, so they can actually hypothesize what the return's going to be on this business. If they're finding funky stuff, they're going to be all over that. And to your point, it's even if there's a reasonable explanation, you got to remember that on the buying side, there's a whole bunch of people that want to scuttle the deal. And actually, it's a lot easy for people. It's far easier for people to come up with reasons not to do the deal than to do the deal, because it actually kind of takes a bit of courage. So don't give them ammunition by doing stupid stuff and trying to hide this and that to get a few extra dollars. Like to your point, if everything that you say and everything that's in that data room matches up, it through the process, it actually builds confidence in the buyer. It makes it more likely that you'll get a deal done because you're not trying to come up with clever things.
That's right. And to your point, buyers, the people in those positions, their jobs are on the line often, and so they're going to be more risk adverse.
Hmm.
So you're absolutely right. The numbers should tell a story, the trailing 12 months, but it should tell the true story. It should tell
Yeah.
the true story of the business. And there is some flexibility, but once you go beyond that realm of reasonableness, I
Hmm.
think you lose credibility, and you can deal will get pulled pretty fast.
Actually, a really interesting example of that. I was looking at doing a deal, it was maybe 12 months ago, and it was a really interesting business. And the owner was kind of getting close to retirement. He'd put in a CEO a couple of years earlier. The business had been really good. A major change had happened in the industry. They lost a whole bunch of money. They kind of went into negative territory. They brought in a CEO. He turned it around. He had all these new revenue streams. I thought the CEO was great, like really honest, super transparent, upfront.
Mm,
Everything was kind of matching. And then they gave me their forecast in the due diligence, in the data room, was a forecast for the next 3 years. And it was like, this year we're going to do 4.5 mil. Next year we're going to do 12.5 mil. The following year we're going to do 27 mil. And I was like, what? I was like, who? So anyway, I'm like, okay, walk me through the assumptions of this 3 year forecast. And the CEO sort of doing his best job. But I could just feel, I was like, I don't get the sense that he believes this at all. I was like, can I just ask a question? Did you put this forecast together or did the owner put the forecast together? He's like, you could see it in his face, like, I've been
mm,
told that I have to sell you this forecast. I don't believe in it. I didn't put it together whatsoever. Every number that's in the past is absolutely factual and true. I can tell you what I think the forecast is going to be, but it's not going to be what you find in the data room. And I was like, how do you do a deal with this owner in that sort of circumstance? But that's a great example. He's trying to make the business look amazing, but actually reduced comfort and reduced our likelihood of buying, not increased it.
absolutely. I mean, you're trying to project into the future, and if someone's giving you phony numbers, you lose trust really quickly, versus if they had realistic numbers and could back up why, hey, here's the ranges of possibilities. I think you'd have more, because then also it makes you wonder, if this business is going to do so well, why are you selling? If it's doubling every year,
Mm, yeah.
why are you selling?
Yeah,
Right?
that's true.
This is another
Yeah.
question.
So, okay, so then let's just say, you've decided to sell in the next couple of years. You got a bit of time to prep. So maybe it's 12 to 24 months of prep and then you
Hmm.
kind of go into market.
Hmm.
Uh, Business is going well. It's growing, 25, 30% year on year. Profitability is healthy and so on. You've obviously got a nice kind of organic tailwind happening. Everything's kind of working well in the business. What do you think when you put yourself in the buying side of, I guess, some of the different strategies they might play out in that previous 12 months? Kind of option one is just carry on as normal, don't make any big or interesting investments, don't seed anything new, just sort of bunker down and keep going. Option
Mm,
two, okay, really, start to focus on kind of tightening the belts, trying to really optimize profitability. So you've got a fatter bottom line, but the reality is you might have made the business a bit lean, and someone may have to kind of reinvest to kind of add some
mhm,
capability because it's probably not going to support ongoing growth at that level, or seeding, or you're actually making some maybe not massive investments but smaller bets on seeding some new revenue streams, some new products, some new opportunities because you think that might help somebody see a greater opportunity in owning this business, but it might actually cost you a little bit. It may not be a capex investment; it might be an opex investment. So it's still,
mhm,
it's going to cost you some earnings. How do you think about that from the buying side in terms of what
mhm.
you think is an optimal way to think about that kind of preparation period and what might help?
It's a great question. So I think the first thing is, what is the buyer buying? So for example, in a in a tech sense, it could be users.
Mm-hmm.
It may not be profitability.
Sure.
If it's a strategic acquisition, it could be, customer list. It could be IP. Um, if it's a is it an add-on to a platform?
Mm,
So I guess, so the question really is, first, who is the buyer and what are they really buying?
Yeah.
Because if it's an add-on, they're probably going to strip a lot of I mean, we don't want to say this, but the reality is they're going to strip a lot of the team out and put them into their existing platform.
Hmm.
Um, so that would be a different look. Or are they looking to buy this as a platform company? Well,
Mm.
then so I think you have to take a step back and look at
What are they really buying?
what is the buyer really buying. I'll walk through each one. So if the buyer is buying the users, the customers, well then yeah, I think you want to invest, you want to keep to build that base up. It's not as much a function of EBITDA as it is in terms of the users. Like for
Hmm.
example, when Facebook bought Instagram, I don't know what the revenue was. I don't think it was based on that. It was based on future
Hmm.
revenue users. So
Hmm.
that's kind of one piece. So now if the buyer is buying an add-on company, okay, what they're buying is they're buying sales.
Hmm.
They're buying some of the profitability. Um, so I think you have to manage it as if it may not sell for 2 years. Like you
Hmm.
think as a seller you're going to sell it in a year. You don't know what's
Mm.
going to happen.
You
So
don't know.
I think you have to continue to manage the business and invest in it. You do want to start, I think, trimming some expenses on the trailing 12-month side to maximize your EBITDA. But from the buyer's perspective, you don't want to hand them a falling knife. You want to hand
Mm.
them a growing business. So I think you continue to invest, expand in sales, you try to maintain profitability. Now, if you're selling a platform company, that's different. I mean, you're selling the whole team, the
Hmm.
leadership, the
Mm.
systems. So everything needs to be in place so that you can bolt on other companies to this. So then I think at that point, the most important thing is the people and the team and the systems so that a buyer says, hey, I've got a platform in place with the team, with the people, with the systems,
Yeah.
and that's profitable. And so then I think you're investing in the team and people in that
Mm.
sense.
Mm.
So and you've seen it's a delicate balance.
It
You
is.
have to be able to keep your eye on the business while you're trying to sell. And there's a well-known performance drag that happens once the deal goes into LOI. The next 2 quarters usually performance drags because the CEO is
Yeah.
focused on the
Distracted.
deal,
Yeah.
thinking about being on the beach and not focused on the ball versus
Hmm.
having system and people in place that keeps things running.
Yeah.
So
And
I
I
think,
think,
like I said, depends on each one.
and something that you said really, I think really is an important message for people to hear, which is you don't know how long this is going to take. So you
Exactly.
might be thinking, oh, I'm going to play this so smart. Like I know I'm going to sell within, 18 months and therefore 12 months or whatever you've
Exactly.
got in your head. And then you kind of build a strategy of what you're investing in, how you're cutting expenses, yada, yada. And then actually you find out you couldn't get a deal done, couldn't find the right buyer, couldn't get the right numbers, whatever it is. You still got that business. Are you going to be happy with those decisions over the next 3 years if you're still at the
That's
helm?
right.
And so you have to continue to build it in a sustainable way, which doesn't mean you don't think about it. What I love about what you said is start with the buyer in mind and think about what is the
Hmm.
value that actually you're going to be creating for them. Because and yes, it may not be one buyer, but it's probably going to be one kind of key type of buyer that's going to be attracted to whatever the most important core value sort of proposition is of your
Yes.
business and how they're going to leverage it to
Yes.
create further value for themselves. That's really interesting. So what about then? And I know this is a hard question to answer, but
Hmm.
the differences or the characteristics between a business that gets 3 times, a business
Hmm.
that gets 5 times, a business that gets 15 times.
Hmm.
Um, you know, what are some of the things that you think are characteristics of business that get lower or higher multiples? How do you think about that?
Yeah. And this really goes to, like, you talk about the value. So I think typically a 3x multiple, those are businesses I'm seeing that are, local, or they're highly risky. I mean, it's funny, before COVID, e-commerce used to be kind of in that, 1 to 3x, 2x, 3x space. Now, obviously, it's more favored, but I think that the 3x is considered a very higher risk investment, um, possibly a lot of labor intensivity, maybe localized market.
Mhm.
Um, it's it's a higher risk investment, maybe less kind of room for growth, I would say, on the three
Mhm.
side.
Mhm.
5x multiple. This is this is like a great e-commerce business that has growth potential. This could be a products consumer products company. It could be apparel, but something that can scale
Yeah.
to where the buyer can get in and grow it and start to really expand. So it's probably not going to be a local business. It's probably going to have some
Mhm.
kind
Some
of
breadth.
local, yeah, international, more than international or national kind of reach. And I think then in terms of you get to the 10, 15, 20x, typically you're talking about a platform company, which for your listeners would be a company that you can purchase and you can add acquisitions onto the company using that as a platform. And
Mm.
so, that 15x is going to be a platform. You do see that 8 to 10x for high growth, hot industries that have a lot of growth potential where there's a lot of bidding going on. So I think that 8 to 10x
Mhm.
is you've got a hot hot industry, possibly a SaaS company, something their subscription revenue where there's tons of predictability, it's
Mm.
very scalable. I think that 8 to
Yeah.
10x kind of would command that. But that's kind of my general overview of what I think in each one.
That's really that's really helpful. And I think that's super true. When I put on my own optics, businesses that we've paid, businesses that we might have paid three times, as you said, we're like, fundamentally we're going to have to do a lot of work here. There might be a lot of
Mhm.
turnaround. There might be high risk, a kind of vendor cliff sort of risk, like, hey, this owner's going to leave, and we're probably going to lose all these key relationships, and we're going to have to have got in and got control of it quickly. So yeah, for us, it's risky. It could go south. And so if we definitely can't overpay, if it's five times, then it's probably, and I used to, it was mostly services businesses that I'm
Mhm.
involved in, less technology businesses. And at five times, you'd expect there to be a suitable level of management capability. If
That's right.
those owners are going to depart, I'm not paying. One of the things I always try to talk about with founders in this sort of 2 to 20 mil space is you got to remember that is, if I'm paying five times your earnings, that's 5 years. If the business doesn't grow at all, that's 5 years before I even get my money back. So, that's essentially the calculation I'm doing in my head and going, well, is that, how fast is this thing going to grow? How long is it going to take me to get my money back?
Right.
And how long till I get a real return? Like, I'm basically buying your future cash flow, and you are selling your future cash flow. So you are going, well, what would I have achieved over the next 5 years if 5x is the best that I can get? Would actually I have picked that up in 3 years if I'm growing at 30% year on year? Maybe I actually get it in 2.5. Like, is it really worth selling this business now for the next 2.5 years worth of earnings? Like, is that the right time to sell? But
Right.
but the 8x's, would have to have some strategic, for us, like probably a pretty strategic benefit. Like, yes, it's either got to be high growth or strategically important. If they've got a kind of market lockup, like they've got a real,
Right.
choke point or something in that industry, it's really hard to unseat them because they've set a standard, or they've locked up the key kind of supply, supply of IP or whatever it is. And we can see how probably we can add a whole bunch more value. If we're going to pay that kind of premium, we can see very quickly, either revenue synergies or cost synergies, we can see how we can actually bolster that quite quickly to bring forward that time for return, because we can take a whole bunch of costs out, or we've immediately got customers that we can take that product or service and sell it to tomorrow, and we think we can really convert on that. So that's really, and I haven't, other than the platform, the last CEO role that I built, and that business is now a platform business that would be commanding that sort of 10x plus kind of multiple, and that's because, as you said, it's a platform. It's got existing capability. It's got suitable sophistication. You can just bolt more businesses onto it. It's already got 6 or 7 businesses now. You could easily add another 8 or 10 or whatever, and actually it's already set for that. So it's got the healthy characteristics. It's a really interesting conversation. I appreciate your thoughts on that. What about, Jerome, negotiating tips? Everyone's always going to have different
Mm.
perspectives on the negotiation. How do you try to think about prepping an owner for the negotiation in the deal? And also,
Right,
what
right.
role do you see the owner playing versus the sell side advisor in the negotiation?
Right. I think that the biggest tip I can give the owner is this is a marathon. It's going to be a marathon, and some processes are designed to weaken and weary the seller into submission by the amount of diligence and getting concessions. So you have to understand
And deferrals
the
of time, keeps
deck
going.
is stacked a little bit against the seller here. But this would be my negotiating advice. And so the advice I got from Marty Lipton, who's an M&A attorney, would be number one, you have to know what your facts are. Know the facts, know who you're dealing with, know who the buyer is, what they want, what they're about, what types of deals they've done in the past, do all the research you can, know the facts, number one. Number two, you be patient and don't give in until it's absolutely clear that you have to. So there's a lot of times in a deal where you're going to want to throw in the towel, you're going to want to give up, or maybe you won't, but you do not give in unless till you have to. You don't know how many deals I've seen where if you're just patient and you wait, you find out there's a way out. And so leverage in the deal switches all the time, but you never give in unless you have to, and you know that you have to. And then the third is I think you just be a straightforward dealer. Like you don't have to fabricate or create things. You just straight up you can tell a buyer, this provision is onerous, right? I don't want a 10-year, liability provision. I don't want a 40% earnout, something like that. I mean, you just have to be real clear, and here's why. So
Mm.
those three things. Number one, be clear with the facts. Know who your other party is. Know what you want. Two is being patient, and three is just being a straightforward dealer. And I feel like those tips have I share those with every client. And again, Marty Lipton's the premier M&A attorney in the world. He's a alumni and someone I've reached out to and spoken to from my law school. And he's got to know something. He's been doing deals for probably 60 years. So that's what I share with
100%.
people.
That's awesome. Yeah, I love that, and I love the simplicity of that because it's easy for owners to get their head around. Can you give me an example on the second point of where somebody may want to give in or give up or capitulate? Like, what would be an example where someone might get wore down and that happens, but they need to kind of keep that keep it together?
What I have seen, Sean, is after the LOI phase, and you're kind of in the middle of due diligence. You're at the APA phase. I do see some deal retreading, and so I think you have to be firm on what you want and the deadlines, and be very clear. And I think that the buyer, if the buyer really wants the deal, maybe they want to buy at a little bit of a discount, and they're going to look for ways to kind of start chipping away at the valuation. And you just have to be firm. Maybe you give in a little bit, something here or there, but you don't give away the farm, and you certainly do not want to give in, because then they smell blood in the water. And then you maybe you haven't been managing your business while you're trying to sell it, and you're kind of in a desperate attempt and saying, hey, my next quarter numbers are not going to look good, I need to sell now, and you're in a bad spot, right?
Mm-hmm. Yeah, you're just handing over cards, hand over fist, 100%. Um, Jerome, I want to say a huge thank you to me for the wisdom that you've shared today. What have I not asked you that you think I probably should have asked you? Things that when you think about, I always tell people this because I think it's really key, but maybe it's a question that I haven't asked you. What else would you like to share with the audience that perhaps we haven't covered before we wrap up today?
Well, I think, listen, I think as a seller, money's really important, and even some sellers who don't think it is, will say it is. I will say it's important to realize what's really important to you as a seller. And I think money may be the top of the list, but it might be legacy, it might be employees, it might be the impact. And I think it's really important to think about that and think about the buyer before. Don't just run to the best offer right away, but look at, hey, is this buyer strategic, someone who gets your business? And because when you start getting into a deal, you want this deal to work out. So I think it's really about being clear about what that buyer looks like, and do they understand your business, and are they going to be able to go through with the deal, not just necessarily the highest price, but what all those things that are important besides the money. I think it's important as a seller to really think about that, because there's some people sell their business and they're just bored out of their mind, and they need to go figure out what they want to do next. I think it's really clear to have a plan in place of what you're going to do, because I think that there is a little bit of one of my clients calls it the what now club. Once you become that millionaire you never thought of, then it's like, what now? What's next?
Yeah, yeah, totally. Yeah, I had quite a few conversations with a member of one of my YPO forums who'd sold a business, and the number of what now conversations that we had over the course of 6 months. He's like, "Well, I'm only 50. Like, what, what am I going to do? I don't know. This is all I've ever done. What happens now? I don't know." Yeah, that's really helpful, Jerome. And I think it's even more important in the context when you think about as the seller. You raised this earlier. It's a distracting process. It's like keeping your eye on the main game and on the ball of running your business whilst you're in a transaction is actually really challenging. It's really challenging, and it's exhausting because you're going to be working some long hours for quite a period of time. And if once you start engaging with that buyer, as you said, you want it to work. Because why? Because you could be spending a good 6 months in that process. You could spend, might take you, 4 to 8 weeks of initial engagement, and if you end up in due diligence, and maybe that goes for 90 days, maybe it goes for 120 days. Like, who knows? It could be a while. So you could be 6 months in with that party. You want to have done the thinking before you started that process, because you're not going to want to immediately come out of it and then immediately go into another one, because it's a hard process. So that pre-thinking, I think, about the right buyer for you, the characteristics of that buyer, how does that work with what you really want out of it, and having all that clarity is really going to help you in the process. Minimize as much friction in the process. It's unavoidable. It's not easy.
That's right.
Hard process as a seller.
If you start to do diligence early, before they get to it, if you get all these things taken care of, you're not going to be doing fire drills and scrambling trying to get it done, and you're going to basically just have more time to focus on the business.
100%.
Yeah, there's going to be late nights, but you're absolutely right. Like, if you get that stuff done early, you don't have to deal with that.
Yeah, I think I mentioned on a few podcasts ago, I give my clients a due diligence checklist just as a starting point and go, hey, this is the basics of what we're probably likely to get asked for. So let's get this stuff organized now. Let's get it happening over the next 6 months, so that at least by the time we get there, you've already got all that stuff. You're not having to think about that. And you're going to get a whole bunch of things that you get asked for that I haven't even thought of. So, be prepared. There's still going to be new things.
That's right. Always.
Jerome, huge thanks to me. I'm sure our community would have found that super valuable. How do people get in touch with you, follow along with what you're doing? Where would you direct them to if they kind of wanted more information?
Sure, Sean. First, thanks for having me. It's been great to be with you. Really enjoyed the conversation. You can go to our website. It's fpgeneralcounsel.com. You can email me directly at jfogel@fpgeneralcounsel.com. That's JFOGEL at fpgeneralcounsel.com. I'm happy to answer any questions I can.
Beautiful. That's very generous. Thank you very much, mate. And folks, if you like today, the best thing you can do for us is leave us a review on your podcasting app. Just helps us get into the hands of more buyers. And if you know somebody else who you think might be selling in the next several years, I'd suggest you share them this episode, because there's a whole bunch of nuggets of gold in here that are really going to help them. This, and probably the last 2 episodes I did with Sean Flynn, is really going to give them a great head start in optimizing the outcome for them or for yourself in selling your business. So thanks again very much, Jerome. Really appreciate your time today.
My pleasure. Thank you, Sean.
Cheers. G'day everyone, just a couple of quick things before you go. If you have questions that you'd love myself or an upcoming guest to tackle about challenges that you're facing in scaling your business, please just jump straight on the website, scaleupspodcast.com. You can record your message straight from your mobile by hitting the button on the right-hand side of the page, or you can just email them the old-fashioned way, questions@scaleupspodcast.com. And just a quick reminder, nothing we spoke about today constitutes financial or business advice. If you are considering making big decisions in your business, seek out a professional who can look at your situation in detail and make sure you're getting sound, personalised advice. Thanks for listening. Look forward to being back in your podcast feed next week.